So the action in the S&P has been pretty ugly of late. Let's take a look at the charts to try to figure out what is going on here. So first a look at the technicals, and then we will talk about the fundamentals a bit. The first thing I see is just a nice orderly bullish uptrend. All of the major moving averages are pointing up. The 50 is starting to turn down a little bit, but just a nice bullish trend. Now the pattern that I see playing out is this head and shoulders top right here. And this is despite breaking out above this bearish engulfing candle that we put in just after Nvidia's earnings. Now once we broke above the high of this bearish engulfing candle, I almost thought for a second that this pattern was invalidated, but all it took was a little Fed speak to knock us right back down. Now we couldn't hold the 100-day moving average, and we got a few closes below it, which makes me think that we are almost inevitably going to test the 200-day moving average, which is about 3% lower. So right now we are showing support at 430, which is the August of 22 swing high. This level could hold. Who knows? We'll just have to see what happens. Now, if we were to trade down to the 200-day moving average at 420, that would coincide with not only the 200-day moving average, but the trend line that has been in place since this bull market started in October of 2022. And it would also coincide with the February swing high, which is around 420. Now, the main reason why we got this decline in the equity markets is because at the most recent Fed meeting, Fed Chief Jerome Powell said that rates will remain high with the possibility of more rate hikes in the future. Now, this caused a spike in the yield of the 10-year, breaking out above the range that we have been in for just about the past year. Now, markets can certainly deal with higher interest rates, but the one thing it cannot deal with is a great amount of interest rate volatility. Now, I think once rates kind of settle in and find a level, the market will follow suit. If we trade down to the 200-day moving average, that would be a 10% move down, which is just a normal average correction. And let's remember that September is seasonally a choppy month, and you actually want to see these corrections because this is all necessary and part of a healthy bullish trend. With all that said, even if the Fed does raise another quarter point or two, we are nearing the end of the tightening cycle, which is opening up the door for the eventual easing cycle that the Fed will embark upon in the future. I know this sounds like I'm talking out of both sides of my mouth, but this is how markets think. So with all that said, I've been adding to my S&P long here and just further averaging into my position. Let me know how you guys are trading this market.